Unmute. Hello, everybody. Welcome to the Thursday Financial Thing live stream. Hope you guys are doing well, having a great week. That's really the most important question is how are you doing? I am over here in the sweltering heat of Florida where we are having a heat wave. Probably if you've seen the news, there's crazy things going on in the environment. It's swelteringly hot here. Hawaii is having wildlife fires, but apparently there's no global warming issues, right? So, yes, that's funny. I don't believe that for a second. Anyway, I digress. But yes, how's everything going? Anyway, we're going to talk about several different things. Quick housekeeping note that on, let me give you a date. There will be no live stream on August the 31st, Thursday, because I'm going on bloody holiday and getting out of this heat, going somewhere a bit cooler. So put that in your calendars, August 31st, no live stream that week. Be back the next week, maybe back early the next week, I don't know, depends, but certainly the Thursday following. And we're going to talk peer-to-peer lending tonight, as we always do. And got also an email from a reader who was asking a really interesting question. So I'm going to pop that up on the screen, show you what that email was and what the question was and what the answer is to this gentleman's query. So anyway, let's get right into it because we're going to try to keep the stream between 30 minutes and 40 minutes tonight, and let's see how we do with that. Dave Dawson is here, Mr. Heliums, Chimpo Naughty, of course, in Cambridge, Mike Powell, Colin Perry, Paul Bagworth in Crete. John Day was asking how hot it is in Crete. Yeah, excuse me, I have to sneeze. Wait. False alarm. I'm sure it's bloody hot in Crete. Seems hot everywhere, right? Except in England. Annabelle Nairn in the Costa Blanca. And is that where they used to film that TV show where the English people were on holiday in Spain and they were at a resort and it was super cheesy but funny? I used to watch that thing. Anyway, Stephen Hale, of course, in Nottingham. Peter Vince from Leatherhead, and there is a fly flying around me that who knows where he is from. But he's been annoying me all day. Anyway, let's get right into it. By the way, I know we're going to talk a little bit about Cufflink tonight. Of course, my sponsor for the show. Please support Cufflink if you have not already done so. Sign up for a free account. Do it through the link in the description. You can get up to 9.83% gross per annum. Over £250 million of property-backed UK investments made since 2016 and zero investor losses to date. Remember that your capital is at risk. Don't invest more than you're prepared to lose. This interest rate can change as interest rates change. It's pretty deep stuff right there. Join cufflink.com/financial-thing to sign up. And there you go. I keep getting notifications from people. I don't know why. Need to turn that off 1 second. Just bear with me for a moment. I see. You know, it's one of those days where the messages keep coming, and I don't want them to keep coming today. So I'm just gonna put on a little do not disturb. Yeah, come on. Why is it not? I don't know why it's not showing up. Oh, here we go. Do not disturb. Okay. There we go. Anyway, let's move for. Oh yes, Benidorm. That was the show. It's a dreadful show, but you know, sometimes you watch a TV show that is dreadful, that entertains you, and you don't really know why. But yeah, back to what we were talking about. Go check out the updated review that I've recently updated for Cufflink on the Financial Thing website. You can search for it up here in the search bar. Just type in Cufflink right there, and it'll come up with the review. Go check it out and see what my new thoughts are about Cufflink. Let's get right into the news. Crowd2Fund users have sent fraudulent emails asking for crypto payments. Crowd2Fund customers have been sent fraudulent messages asking for crypto payments, which Crowd2Fund has said is due to a third-party marketing tool that has been compromised. An email, which is looking to come from Crowd2Fund, asking for cryptocurrency, enabling its users to deposit, invest, and earn and withdraw crypto. The email said it has randomly chosen 100 users of the platform and asked them to send any amount of Ethereum to a web address by August the 13th to receive a bonus of up to 15%, depending on the amount paid. The fraudulent email also promises increased interest APRs for crypto investments into the platform. Crowd2Fund has said, it's come to our attention there is a suspicious activity representing Crowd2Fund via text message and email. We urge users not to send money or click on any links. Well, look, I have to address this because it is just coming up so much. I mean, you probably already get these emails in your account. I get them every day saying message from Coinbase or one of these other wallets. And just ignore them. Anytime you get any type of email that's asking you to deposit anything cryptocurrency related, it is almost always, I would say 99.99% a scam. And yet, there are still people that continue to be hoodwinked by these messages, and not just cryptocurrency. I have seen these types of messages come through for stock trading accounts, credit cards. I get emails from, looks like American Express or Visa, from my bank saying, click on this link to log in. It's just, there's so many scams running around like right now. What I recommend is go to the email address itself and just click on it, right click or whatever you do, and just check where the email came from, because most of the time it's going to be some Gmail address or some gobbledygooked address email that it was sent from, and you can pretty much tell that they're scams. But needless to say, don't click on any links you're not sure about. Don't send anything to anybody, even in peer-to-peer. I've had peer-to-peer lending emails that look like they came from the peer-to-peer lending companies trying to get me to click on a link. It's very dangerous stuff, so stay vigilant and be aware, and then you guys will be fine. Easy access accounts are on the decline in peer-to-peer lending amid regulatory scrutiny. Easy access accounts were once the norm among peer-to-peer UK lenders, but today there are only 3 platforms now that offer them. Once advertised as an answer to the question of liquidity, easy access accounts allow investors to withdraw their money at short notice. That is, of course, if liquidity exists. There are only now 3 companies in the peer-to-peer lending space in the UK that offer such easy access, and I put that in quotes because it really isn't not easy access, but supposedly easy access if the liquidity is there. We now have Easy Money, which has a easy access account, which allows lenders the option to withdraw at any time while conditions exist. Instant access is not guaranteed, but over the past 12 months, the platform has made withdrawals available in less than 24 hours on average. You can get 5.28% up to 8% returns on Easy Money. Then we have Just Us, which offers an easy access account which only pays a minuscule 1.2% per annum. Not sure why anybody would sign up for that account at the moment. And then third, last but not least, is LoanPad, which right now is offering, I think it's 5%. This article says 4.8, but I believe it's 5%, and that's going up again soon enough. So they are offering what they consider an access account. So yeah. Then we have our friend Gobinda from Cufflink. So he has gone on record with peer-to-peer finance, news credit to them, to explain why Cufflink decided to increase their minimum investment account amount from 100 up to £1,000. What Gobinder is saying, it's in an effort to enhance its investor process. This fly is driving me absolutely. It's one of those tiny little, midget flies, and I just can't get it away from me. It's been hours. Anyway, that's why I'm flapping around, if you see it. So what Cufflink is saying, that it's tightened its borrowing criteria in recent months in an effort to manage the risk. The company is now turning its attention towards investors. They're looking at their investor behavior, and what they're saying is, we want to ensure our investors understand the risk of delay in repayment if a loan term has to be renegotiated. We don't want to be in the position where our investors would struggle if there was a delay in loan repayment, especially these days when inflation is high. So we decided to up the minimum to £1,000 to ensure that only suitable investors join the Cufflink platform. Okay. And then most importantly, and I think this is what we talked about last week when I gave my thoughts about what was going on with Cufflink and this increase, it's exactly what is being stated here. At the minimum, the system allows you to reinvest or invest smaller amounts in self-select accounts as long as it equates to 1p of interest per month. Gobinder says, now you can imagine the amount of work that it takes across the business when you have someone who invests less than £5 at a time. Apparently, the response to the increased investment minimum has been mostly positive, as the vast majority of the platform's investors understand that the regulatory landscape is changing and new market risks are emerging, and ultimately the higher investment values will help keep Cufflink to deliver a more efficient, compliant, and protected business no matter what the economy does next. So, as I suspected, that Cufflink was experiencing many investors who are investing really small amounts of money. It was becoming a exhaustive process of resource-intensive, probably process of managing these smaller amounts of investing. And they said, well, let's up the investment amount to weed out the low, maybe not, I shouldn't use that word weed out. And this is just my opinion. But they're trying to focus their business on people that have the financial resources to put in more money and who are probably not so worried about the loans getting extended. I think I would have to agree with the article that usually when people are investing small amounts of money, they tend to be more worried about their investment and more concerned when they see maybe a loan getting extended here and there. Maybe they need that money to be repaid to use for other things. Sounds like Cufflink's decided that higher net worth investors don't have those constraints, and they want to ease the burden of the administrative process on Cufflink. So I definitely understand both sides of the argument. I think that it's kind of disappointing that Cufflink will no longer serve people who don't have £500 to put into every single loan. It does create diversification considerations. Be nice if their auto lend product maybe allows some type of exit, because I think a lot of people would be okay putting the money in the auto lend, but there is no way to get out of that, those 1 year minimums. And but it does provide just a larger amount of diversification that's much easier to deal with than using self-select, where you're having to pick out your own loans. But also getting paid interest once a year doesn't necessarily work for a lot of people. So I do understand both sides of the story. I'm really defending this decision. I kind of am neutral to it, really, to be honest with you, because I get both sides. We don't know what it's like to be on the other side of running a business like this, and how resource intensive and how employee intensive it can be to have just these tiny small amounts of transactions running through. I don't know what exactly is automated. I would imagine there has to be some kind of human element involved to things like withdrawals and processing small transactions. So I get both sides and I understand it. And I think you're probably going to see this being the norm moving forward with other companies, and we have seen other companies having a much higher minimum investment amount. And you just have to kind of be prepared for change, and change is always happening in peer-to-peer lending, and this is one of those changes. Let's keep going. This is a really good article. I enjoy this. Irish small and medium enterprises have eschewed banks in favor of peer-to-peer loans. Now, this did not come from a peer-to-peer lender, right? This is what I liked about this article. This quote came from a guy who is the chief executive of the Irish Small and Medium Enterprise Association. They're saying small businesses in Ireland are favoring peer-to-peer lending companies for finance due to their speed and flexibility. And this is a business expert. He said the business's lobby group members are increasingly turning to non-bank lenders such as peer-to-peer companies like Linked Finance, Grid, and Flender, or merchant cash services that extend credit and take a percentage of till receipts. He blasted the dreadful service of high street banks, according to a report on the Sunday Times, and said that small firms cannot be bothered to invest the time applying for loans with them to get a slow no. McDonald reportedly said that small businesses like the quick turnaround times on loan applications from alternative lenders and use them for working capital despite the higher cost of finance. Banks are reporting bumper profits, yet lending to small businesses remains subdued, indicating this area of finance is not a key focus to them. The latest bank lending survey from Ireland's central bank, cited by the Sunday Times, found that lenders in the country have tightened their credit standards in the second quarter, while demand from firms, except small businesses, increased slightly. You know, this is something that is quite really obvious to me. I have seen a borrower application from that side within peer-to-peer lending and from the bank side of a high street bank. And I can tell you that high street banks are so slow. I mean, it takes them months to approve loans, and small business, I don't think they really care about lending to small businesses. That's probably it. They probably just think, well, it's such a small amount of money to them that they could care less if it, takes them 6 months to get a loan approval or denial to that small business. And this really kind of shows the future of why peer-to-peer lending exists and why I think it's such a great sector of finance, because it does cater to the small and medium-sized businesses that do not want to deal with high street banks. So when we're actually lending through these peer-to-peer lending companies, we get to see why we are doing that and how we're actually helping small businesses get lines of credit that if they purely had to rely on high street banks, they just probably would never get those loans. So good on you, peer-to-peer, for being that vehicle. Quick bit of news, not really peer-to-peer, but a friend of the show, Plend, Rob Pascoe over there, has secured a funding line from German institution Warengold Bank. Is understood to be an 8-figure amount. So that just shows that Rob over there at Plend is continuing to grow. Obviously not within the retail space. I think he's understood that is probably not the best route for Plend, but they are doing some pretty cool stuff. For all you people who are interested in European peer-to-peer lending platforms, Twino, I don't know, anybody know how to pronounce that company name? Because I honestly don't. They have launched a real estate security product, allowing investors to diversify their portfolios by funding short-term rental properties. The new product, which it calls RE Securities, invests in the acquisition of a property that is or will be rented out in order to generate rental income and capitalize on the appreciation of the property's value over the long term. Twino investors can put in a minimum of €100, 86 pounds, to start producing real estate income. We will take care of all the real estate acquisitions and management operations, so you can experience a truly passive investment experience, collect net rental income, and benefit from property appreciation over time. Technically, the product works by allowing investors to purchase preference shares of Twino's subsidiary, Twino Properties. Twino Properties own the property assets and handle all aspects of property management. This is an equity investment where dividends are paid out annually, and any appreciation in value will be realized once the property is sold, which Twino anticipates to be within 5 to 10 years of the purchase. Oh, Lord. What can I say? I mean, Twino, have you looked at London Property Exchange? Have you looked at the House Crowd? Have you looked at Property Moose? Did you guys study these business models at all? Because they failed doing this exact thing. Managing real estate investments through shares is... Who has been able to do it? Assets Exchange seems to be able to pull this off. They have a very niche product, and even they say there are struggles with it when it comes to acquisitions. Twino, by the way, is only offering 6 to 8% for this product, which is, it's not great for the risk that you take. And it's sad because all of these companies that have tried to do this have either failed or might, side of Assets Exchange, we're going to take them out of this statement because I think they are actually doing a good job. But every company that's tried to do this type of business model has failed due to either incompetence in management or because the business model did not work. So the House Crowd was basically management incompetence and investment incompetence, and Property Moose, Andrew Gardner saw that the business model wasn't working, and he decided to pull the plug before everything went to complete poo, and he just made what he thought was the right decision. So this statement, this goes back to what my dad always told me about: stick to what you know. Does Twino know property management? They're a peer-to-peer debt lending company. I don't know if they have any experience in this field, and it would make me very nervous if I was a Twino investor to see them branching out into something that is not their place. Like, they don't really have that history to show, and I would be very concerned if I was investing in Twino, because we've seen other companies that have changed tack and tried to do what they don't know. Let's look at MoneyThing, for example. Started out as a pawnbroker lender. Funding Secure started out as a pawnbroker lender. Granted, much, I think, smaller than Twino, but they started out in different sectors and then tried to move into property, and it failed. And I don't have a good feeling about that one. So if you are in Europe and you're a Twino investor, be very aware of this story because it is important. And what they're doing here, the platform is offering a 5% cashback bonus to celebrate the launch of the product. It is currently working on a secondary market for RE securities, so just be aware. Personally, I don't think it's a great thing. We'll see what happens in the future. Easy Money Chief said investors are attracted to IFISAs in an uncertain time. So he is giving the thumbs up for IFISAs. This was a very interesting statistic that I got from this story. 144 million was put into IFISAs in the 2021 and 2022 tax year, which is up from 92 million the previous year. But IFISA volumes is substantially down from the 2019 and 20 peak when 995 million went into that product. So right now, there is about 15% of the money that was going into IFISAs in 2019 and 20 now has dropped to 144 million. So what is the reason for that? Well, that could just be economic situations where people just don't have the money to put into ISAs for stocks and share ISAs or peer-to-peer lending ISAs at the moment. There is this obviously much higher cost of living situation that's going on, possible recession, which I still think is coming. If it's not here already, I think we're still on the verge of something big. Put that on record. But people just don't have the money probably to put into these ISAs like they used to. There is also what I believe, some people get burned when they invest in stocks and shares. And, when the markets are doing roaringly well, which they were after the, in that 2019-20 time, I think they were just doing a lot better. Well, when was the CVID? When did we have the stock market drop? But usually what happens is people go into the markets when the markets are good, and then they get really gun shy when stock markets start to retract, and that's when they won't buy stuff because they're doing it completely opposite of when they should be. Everybody who bought, I think it was in March 2020 when the markets dropped, was it 30%? Hope I'm getting my dates right. People that bought in at that time did really remarkably well after that. But everybody who didn't, who sold at the wrong time, they get burned and they don't want to go back in. So, yeah, we'll see what happens in the 2022-23 year. But I think IFISAs are really a good thing that everybody should definitely be using, maybe in combination with cash ISAs, but you're just not going to get that interest in a cash ISA in the way that you could possibly get a better return in an IFISA over a very, very long period of time. I'm talking 10 plus years. Obviously, your money is getting eroded if you're just sticking in a cash ISA at 4%. And we've seen, what's happened with the stock market, where we've had a really good, I think a good year to date. We can look at those numbers, but cash ISAs are just not going to perform against the stock market long term. So use your cash ISA if you need to, but use an ISA for sure. Use the IFISA if you need to. Lending Works. This came out in July, end of July. I just haven't had a chance to look at it. This is a report for all you Lending Works investors, which I am. I have a relatively small balance left now. Everything is getting repaid back slowly. But it's saying here, expected annual returns and loss rates have remained broadly stable for Q1 of 2023. Overall expected annual losses on the active portfolio have slightly increased from 3.7 to 4.1%, which they are monitoring. Average returns on past cohorts 2014 to 2019 are 4.4% for growth per year and 3.8% for flexible, which is, it's still pretty bad, isn't it? If you can get 4.5% in the bank now, you're not going to be really happy with these interest rates. As you can see down here, the current rates right now, flexible 4.0% and 4.5% in the growth. Long gone are these days, right up here of 2019 when it was 5% flexible, 6.4% growth. So these numbers have really come down. What is a good thing, I would say, even though it's not a huge balance, but the Shield cash balance has 1.1 million pounds in it. And that's accounting, hopefully, for any potential problems with the loans that come up. So there is that money in the Shield account. So if you have a Lending Works account, you're concerned about getting paid back. I think they've done a pretty good job of continuing to pay back money. At least from my own experience, I've been getting little chunks of money that have come into my bank account every Friday as loans get paid back and interest gets paid back. So not too concerned about Lending Works at the moment. Some pretty interesting reports that have come out about the global peer-to-peer lending market, which is definitely a lot bigger than I actually thought it was. There has been a research study titled Peer-to-Peer Lending Market Size, Trends and Insights by Business Model, right? this research has said that the global demand for peer-to-peer lending market size and share was valued at approximately $75.8 billion US in 2022. It's expected to reach $130.3 billion in 2023. That's a big jump. It's a really big jump. Almost, what is that, 90%? And then reaching around $623 billion by 2032, which is an annual growth rate compounded of 28.1%. And it goes on to say, some of the things that are causing the peer-to-peer lending market to grow. We've got technological advancements, attractive returns for peer-to-peer lenders, lower borrowing costs. I'm not sure that I necessarily agree with that. I think sometimes the borrowing costs for peer-to-peer can be higher than other solutions, but in some markets the borrowing costs are lower. Regulation and market security, online convenience, diverse loan offerings, and disruption of traditional banking, which I particularly love. I love anything that disrupts traditional banking. Why do you care about this? Because you're investing into a sector that is looking to grow, 6 times by 2032. So it means that the sector is going in exactly the right direction, what we want to see. Also, another report that came out on August is also showing that the European peer-to-peer rate of return on average for Europe was 10.4% compared to May. So it seems like the European peer-to-peer lending companies just pay more because interest rates are higher over there. So if you are invested in those Euro companies, you are going to get more interest. But I believe you're also taking a lot more risk too. Your regulations are different over there. The way loans work are different. But you are getting risk to reward balance. Also, another interesting article is talking about why is in the U.S. peer-to-peer lending not bigger? Because the U.S. tends to be pretty advanced when it comes to alternative finance, but the loan book value of the total amount of peer-to-peer in the U.S. is actually not too big compared to the size of the country. Prosper is the biggest one in the U.S., which is $23 billion. They do cater to retail, but a lot of the peer-to-peer lending companies that used to exist in the U.S. have been really susceptible to regulation by the SEC, the Security and Exchange Commission, and they've really put a clamp down on a lot of the peer-to-peer lending companies in the U.S., making it very hard for them to operate because of the administration burden. So we saw obviously companies like Funding Circle that was in the U.S. They went completely institutional, as they did in the U.K., because they could see that the regulation was tricky for them, and they thought that institutional was just a lot easier than retail, which we've seen plenty of times. Personally, what I think is going to happen is that wrong screen. There's the dog. What I think is going to happen is, as long as the regulation in the U.S. remains how it is, I don't think you'll really see too much growth in the peer-to-peer lending side of it. It's going to be more of a UK and Europe niche product until that regulation changes. I think the U.S. is going to be somewhat limited. I just wanted to show you, between you and me, hush hush, I managed to get a Prosper account that I did use for a few years. And I want to show you what my rate of return was. I don't have any money in here anymore because it performed really badly, and I took it out because of this reason. You see here my return, and this was over, you see here I started in November of 2017, and then had a good May of that 1 year period. I don't know if you can see this. I'll zoom in a little closer. But that first year, I got a 13.32% return on this Prosper account. And then things just seemed to dead cat bounce, just down, boing, boing. And then this is when I started to withdraw, when I saw right here in August 2021, I saw that on average the account wasn't doing too great, and I think I sent my withdrawals around this time. I kind of saw the writing on the wall with these Prosper investments. They are consumer loans, so there was a lot of defaults going on, but it just didn't really perform well. And this is the only thing that, honestly, when it comes to a big company like this, that you want to see some long-term return that's good. 3.4%, not so great. You can see here, look at the return on the AA rated loans that were the best, right? These are the ones you expect to perform very stably. Well, I was getting a 0.6% return on AA. The return that was doing well were the E-rated, which were the worst loans that you could get, the highest risk with the worst credit borrowers, and 28.875%. So in order to get a really good return on this peer-to-peer lending company in the US, you had to, take massive amounts of risk that could have quite easily have gone the other way, because E-rated borrowers are E-rated borrowers for a reason. And personally, I had it diversified over all these different areas of risk. Look at your D level here, minus 1.65% return. C-rated was really the only positive aside of the E-rated, 2.37%. And yeah, it's just not great. Just not great. Right now, the only little bit of cash I have in here is in this E-rated loan. And yes, I'm definitely not continuing with this investment. So Prosper has not really been too good to yours truly. But that's just part of the risk of, when you invest in these companies, you don't know what's going to happen. Let's go into the mailbag. I got an email a few days ago from a very kind listener of the YouTube show. Said, first of all, love the stream. Thank you very much. And all the good content you put out. Just a bit of background. I have been diligently saving up money for several years in hopes to have a decent passive income source, spelled S-A-U-C-E. I don't know if that if that was intentional. And it said, from Sun Theatre Burlington companies I invested through. I don't really know what that is. I'm 37 years old. I would like to have enough investment to provide a £55,000 a year income. I don't like my job, and I would like to be able to buy a sailboat and leave the 9-to-5 rat race behind for good. My question to you is, how much money do I need to invest approximately to reach a £55,000 a year income? So far, I have investments through LoanPad, Cufflink, Crowd Property, and Easy Money. Any suggestions would be brilliant. Keep up the good work. Thank you for the email. It's really not that hard to figure out to you. Basically, you just have to figure out what percent you need to get a return from a set amount of money in order to provide that income. Now, the problem is, whatever way you turn to, whether it's peer-to-peer lending or stocks and shares or bonds, those interest rates fluctuate. So this is never a really fixed amount of money that's going to provide you that £55,000 of income. I'm presuming that this person, when they said Sun Theatre Burlington, is some kind of a stock that they have. I couldn't necessarily find what it was. But if we look at, for example, turning towards our trustee Vanguard fund on the income side, this is the U.S. equity, you're only going to get 1.5% of dividends here, and this is only paid once a year. So 1.15% gross, you got to pay tax on top of that, is really not going to get you particularly a good amount of income. Now, of course, you can turn to peer-to-peer, and what I tell people is, if you're averaging your money across different diversifications, you're probably going to be looking at 6 or 7% return. So if we take that as a sort of general rule, how much money are we going to need to invest for this guy to get 55%? So let's say we start with £500,000 at and this is simple interest. Let's go 6.5%. He is going to get himself 32,500 a year. So that's not really going to get him there. What I think he's going to need is probably closer to 750,000 at 6.5%. No, a little bit more than that. So maybe 800 grand should get you 850. You're looking at quite a substantial amount of money to get to that kind of, yeah, wait, there we go. A little bit less than 850,000 a year, getting you 6.5%. In order to get that equity income of 55,250 pounds a year. So if we move these returns down, obviously that number then changes. So if we go to 4% now, you're way off 34,000. If you go and shoved it all into the index tracker and you were to get 1.15%, now you're massively under at 9,775 pounds. Now, this is the reason why people start to take big risks and try to get these 10% returns, because they can take 500 grand at that point, or 550,000, and get themselves to that 55,000 pound interest number. So it really, again, goes back to how much risk you're willing to really take to get to your number, or maybe you're just going to have to stay at that 9 to 5 rat chasing job that you hate until you can accumulate close to 850,000 or £1 million, and then use that, to create your 55,000 pounds of income. Now, of course, you could also do different things. I mean, you could buy a rental property in the north of England. Maybe you could get closer to 10% returns on that, but you're going to have some downside with the landlording, putting in repairs for the property. All kinds of mishaps can happen. I know, as a partial owner of rental properties, the boiler goes, that ends up costing you £2,000. The conservatory starts leaking, that was another £2,000. The washing machine blows up, that's another £400. So you just have to put all of that into your risk focus. And do you want to become a landlord? Do you want to be diversified into property? You need a lot more money to be able to clear interest and dividends off of a rental property. So yeah, the fact that the person didn't actually tell me how much they have in their starting point, which is an important piece of information, because if they said, well, I've got 800 grand saved up, then this is a much easier question to answer versus somebody who's got 25,000 pounds saved up. But there is also this kind of myth that peer-to-peer lending is going to provide this really, really strong income with low amounts of money. That it's just simply not true. It's all a math game. It doesn't matter whether you're talking about stocks and shares, fixed rate bonds, or peer-to-peer lending. The numbers don't lie. Whatever that interest rate is expected to be for the year fluctuates what kind of income you get. So that was a good question. I like his diversification on the peer-to-peer side with LoanPad, Cufflink, Crowd Property, and Easy Money. I think that's a good mix of some more fixed rate stuff that doesn't quite fluctuate as much as obviously the stocks and shares have done. Speaking of stocks and shares, oh, by the way, we had a inflation number that came out in the US today, which is interesting because it kind of went up a little bit. We're now looking at 3.2% inflation year on year, but that's a lot better than where it was at 9 or 10, but still not where the US wants to be, in that 2% range, which I personally think this is going to be the new norm. The 3% for inflation, 3 to 4% is going to be the new norm. I'm glad those numbers weren't worse, but yeah, they're still not where they want to be. So this could mean another interest increase, although I don't expect it. Let's look at the trading 212 portfolio very quickly. We're sitting at 18,130 pounds. You'll see here that there's less in the free funds amount. More of this money has been deployed, so we're sitting on 3,000 pounds in cash. Alibaba added to the position. We had a good day today as they announced good forecasts, so up 4.3% today. So around break even with that. Of course, I have bad market timing, so when I invested, you can see in Alibaba, I invested at $100.50, so we are a little bit below that. Canadian Overseas Petroleum is still inching its way back, but we've had an 80% increase over the last month. Our death spiral stock, which is somebody in the chat said death spiral stock. I think it's going to be okay. Deutsche Bank down 8.4%. Flex natural gas 17.58%. This one has been another bad trade. DNA Ginkgo Bioworks, which has screwed the portfolio. Now this is the second time. They just, I don't know why I keep going back into this. Looked like a value proposition, but now who knows with them. Green Power Moto down 14%. Calera is sticking strong, 65.73% in the green. Norwegian Cruise Lines had a pretty tough week. You can see here, let me click on the chart here. Come on. Yeah, we were seeing 1851 down to 18. Then we saw a nice rise up, which I think I went back in around here. And then the valley death drop down all the way to 1780, which is, come on, Norwegian, get your act together. Get on that ship, start making some money. And then Vermilion Energy has come back in the last month, 11.52%. So the portfolio just seems to still be floundering around, but I think heading in hopefully the right direction. We'll really want to get to 20,000 by the end of the year so we can make another donation to Worldwide Healing Hands and Forest Home in Poole, the hospice charity, which I do like to support. So come on, stock market. Let's go. What are you doing? What's going on? Markets are looking better today than they were, but they were looking really good this morning when those CPI numbers came out, and then everything just seemed to, fall back again. So we went from 4524 in the S&P down to 4524 down to 4458. So a lot of the times this is just traders moving the market, and they, sell when things go up and then take their profits and run, and it makes the markets move the way they are. Anyway, I hope you enjoyed the information today. Right? Let's see if you have any interesting comments. 33 degrees in Crete. Yeah, it's about the same here in Florida. We got dreadful hot weather. Anyone use Landlord Invest? As pointed out on the forums, that Cufflink article is nonsense. I just, I don't know. I don't know if it's nonsense. Could well be. Who knows? What do you think the real reason for them doing what they've done? I don't know. I don't know what's automated there and what's not automated. I honestly think it's probably people, from a customer service side of things. And I know because other companies have told me this before, but retail investors can be really harsh on the company's time, just calling up. What's going on with the loan extensions? And maybe they just get tired and they don't want to deal with the guy who's putting in £5 into a loan. I get it. If I'm losing credibility, sorry, I don't know what to tell you. What do you think that the reason for Cufflink doing what they did? I'm interested to know. I don't make these decisions. I'm very unbiased. I give you my opinion. It's not forced to be right or wrong. I'll say if I think things have been done that I don't agree with. Like I said at the beginning, I would prefer Cufflink always to support the people that have supported them right from the beginning. But that's just not the way it is. We don't have any control over that. And you always have a choice, if you vote with your money. I always have said this. There is no loyalty when it comes to what you're doing with your investments. If you don't appreciate what a company is doing, then you vote with your money, right? You don't have to invest through those companies. Put it somewhere else. Mm-hmm. Honest answer: cost. What do you mean? What is the cost of what? They've said in the article it's resource intensive. Isn't that what it comes down to? You got to be able to operate your business in a efficient manner. So, yeah, I don't think it's nonsense that the article, it does state that it is resource intensive, which obviously is money, If they have to have an extra amount of employees to deal with the guys that are putting in £5 into a loan, then that is expensive for a business to do. And personally, what I think they could have maybe made the minimum 200, 300 or something. I don't think they had to go as high as 5, but obviously they have their reasons for doing it. I think Cufflink is being pressured by the FCA. Could be that too. And also, I don't think you guys understand how. That's a good point. I don't think you understand how difficult the FCA is to deal with. They put a lot of rules and regulations on these companies. Some of them have to have somebody there just to deal with the compliance, the FCA, just a single employee. The problem is the nonsense argument that they are making things safer. Okay, so what I think about that is, in my experience, people that have more money to invest tend to be more experienced investors than the people that are investing very small amounts of money. I've seen that personally many times that I have communicated with investors who email me. The ones who are least experienced tend to be the ones that are putting in the smaller amounts of money. That is so, just the way it is. But and I'll go on record for saying, sometimes change has to happen. Sometimes it's not going to be the change that everybody wants to see. This isn't the first time that a company has changed what they're doing and people haven't liked it, right? So vote with your feet. If you don't like it, you don't have to invest that. It's very, very simple. Yeah, I've exited more than one company that has made changes that I didn't agree with, and I just got out. Loyalty is, when it comes to money, you got to put your money where you think it should go. To support the companies that you believe are doing a good job for you. It's your money, it's your investment. Well, like I said, that's my experience. I don't know about the people who invested through lending. My experience, the people that I communicate with who email me, has been the people that have less understanding are the ones who are investing smaller amounts. So that's my argument. I'll stick to it. I can't speak for the people on the forums and other people that have invested money because I don't know those people. I've never had any communication with them. I don't know what their level of experience is. But the people who contact me personally, that's the way it's been. So, and generally the ones investing smaller amounts of money haven't invested in these companies before. They're doing it to try things out, and they tend to be smaller level investors. And here's another thing, this wouldn't be the first time that people or a company wrote things to justify what they're doing that you may see as kind of being nonsense. I mean, we don't really know the real reasons why these companies do what they do. They only know that. We don't know what goes on behind closed doors. If we did, we would have pulled all of our money out of Lendy at the right time, right? Or these other companies that fail. We don't know what goes on behind closed doors. We can only go off the information that we're given. And if you don't agree with that information, then just walk away from the company. So maybe we'll have to agree to disagree. You know what? I still love you guys. I am just, I just look at the information that I'm given and report that to you. So whether for right or wrong, that's it. Oh, I'm not. Yeah, I'm not rattled. I still love every single one of you. You know. Yeah, I think that's an interesting point too. Minimum of say 250 to 500 should make investors analyze. Maybe it will make people think twice about what they're doing because of the bad experiences that they've had in the past too. Look, if you're investing, here's my point. If you're, say, a self-select investor at Cufflink and you're investing a 25-pound chunk into a loan, are you going to do any type of due diligence on that loan? No, you're not. Most people won't. They're just going to put in their little chunks of money and not pay it any attention or mind. But if they're putting in a more significant amount of money, they are going to do probably more due diligence, and maybe they're not doing that right now. So, yeah. And I'm not rattled. Actually, I've been having a tough day yesterday, so maybe I am a little rattled. So, anyway. How long have we been going for? I still love you guys, like I said. It's just an opinion. Everything is an opinion. Yeah, one thing I learned in my life too, by the way. I went on a weekend seminar once. It was a 4-day thing called Landmark. If you ever get to do it, I highly recommend it. It's really cool. But what they taught me on that seminar is there is no right and wrong in life, right? Right and wrong is just a word that somebody came up with to identify right and wrong. Right? All there is opinions. Of course, there's moral things that are right and wrong. You don't want to go stealing from people. You don't want to kill people. That's certainly right and wrong. But there is mainly no right and wrong. It's just about opinions, what you think is right, what another person may see is completely wrong. So they're just opinions. They're just opinions. Anyway, I'm going to get out of here. Be back next week. Like I said, I'll be getting one of the Cufflink guys onto the stream hopefully this month. I think 27th. Oh, is that going to work? Oh, maybe September. Anyway, so you guys can ask all the questions you want, and we'll get the real truth. I think that's the best thing, right? We get to the bottom Whether we'll get the real truth answer or not, I don't know, but we'll try to get to the bottom of the reasons things happen and why they did what they did. So thank you to everybody for being here. Thank you to the loyal Patreon subscribers. I really appreciate each and every one of you. I do. I have much love in my heart. I see you kind of like my Thursday family. You know, we've been doing this stream for several years now, and yeah, it's really is a blessing, and just the fact that you guys show up every week to come and express your opinions and to listen and chat amongst yourselves, I think is pretty great. So thank you and much love to you guys. I will see you next week from myself and Harley and my sponsor Cufflink, who is in the doghouse. We all love you guys anyways. And one thing I would also say to think about is, if Cufflink has treated you well in the past, you would hope that they would continue to do that in the future, even if they do have to change their terms and conditions for whatever reasons they decide they have to do that. Maybe think about how they have treated you in the past. Hopefully it's been a good experience, and you can go from there. Anyways, I will see you next time. That's all I got from, let's take a look at Holly one last time. She doesn't care about Cufflink. So we'll see you next time. Have a great night and a great weekend. Take care.